Hello and welcome to the tax roundup for June. Are you ready for the end of the financial year? Me neither. But before we get going today, if you haven't seen it already, the Tax Office has extended the deadline for compliance with PCG 2016/5, which of course is the non-arm's length limited recourse borrowing arrangements for self-managed super funds. That's now been extended to the 31st of January 2017. Bit of welcome relief there. Today we've got a series of things we're covering. Even though the government's in caretaker mode, there was some legislation, very important legislation, that snuck through Parliament just before the government went into that caretaker mode. Rae then will also be looking at the ATO's attack on property developments and trusts. And Mike will be leading us through the new 10% withholding tax for sales of property by foreign residents and why it's much more extensive than people think. The ATO have now released the forms to start dealing with that, which all practitioners should be aware of. So across to you, Mike.
Now, hopefully by now, accountants, tax agents, lawyers, conveyancers and real estate agents are getting their head around the new withholding rules that will begin from 1 July 2016 for certain property transactions, share transactions, transactions involving units in unit trusts as well. Now, again, hopefully lots of people have got their head around the fact that these rules, which are starting from 1 July, can potentially apply to a much broader range of situations than we might have first thought. These are the rules that are really aimed at improving tax compliance when a non-resident sells certain types of Australian property, and that could be shares in a company or units in a trust, or it could be land and building strata units, that sort of thing. There are lots of ranges of kind of issues to do with those rules, but probably one of the big updates to give at the moment is that the ATO has started releasing some of the forms that need to be used to comply with the new legislation. So we have ATO forms now to apply for a clearance certificate. This is relevant where a transaction relates to land and building, strata unit, that sort of thing, and you want to prove, or at least provide enough evidence to a purchaser that the vendor is a resident of Australia and therefore withholding is not required. So the form is available now to fill out and send off to the ATO to begin that process. Forms have also been released to vary the withholding rate. The default rate is 10%, but it can be varied down. You just need to provide a good reason for that. So again, the forms are available in order to be able to apply to the ATO for that. The other major form that has been released is when the rules are triggered and a withholding obligation arises, the purchaser needs to notify the ATO that that's occurred, and that's something that needs to be done on settlement. The form to do that has also been released by the ATO. So as well as paying the tax to the ATO, the purchaser has to notify the ATO of some basic details about the transaction. So the form is there too. So all those things can be found on the ATO website. It is really important, if you're not really on top of the rules just yet, it is important to at least have an understanding of where the risks are, because there are potentially adverse implications for either vendors having to miss out on some of their sale proceeds unnecessarily, or for purchasers not realising they have an obligation and then getting hit with large PAYG withholding penalties, general interest charge, and those sorts of things as well. So if you're not across the rules already, time to really kind of look into them, because these rules can be triggered in as I say, a much wider range of scenarios than you might otherwise think. But in terms of compliance, from 1 July 2016, the forms are there. You can start kind of working with those from whenever you need them.
Now across to Rae to look at why the Tax Office is so interested in property developments working through trusts.
So property development and trust. This is an area the Tax Office has been looking at for the last couple of years. You might recall that TA 2014-1 raised their concerns regarding trusts that were carrying on property development activity, but then reporting the sales on capital account and claiming the 50% CGT discount. The Tax Office have increased their focus on this because they don't seem to see the problem is going away. And as part of the Trust Task Force, where the Tax Office look at specific issues for trusts, they've said that 75% of the trusts they reviewed have been sent on to audit in relation to property development activities that have been incorrectly reported on capital account. So the types of things that the Tax Office are looking at is whether this trust is a new trust that's been established for this particular activity, whether it's an existing trust with a history of property development, whether any of the units that have been developed as part of that development have been sold prior to completion or advertising for sales prior to completion, and if so, how is the trust reflecting those in the ongoing reporting of that property development activity. It's an area that they know Mistakes continue to happen and they are continuing their focus of it. So if you have any clients operating in this area, do make sure you're aware what level of documentation they have to support whatever position is being taken. Now, separate to that, the Tax Office have also announced that they have real property reporting that's going to start, effective from the 1st of July 2016. This will be a quarterly report that all states and territories are going to be required to provide to the Tax Office. That will include details of the vendor or transferor, the purchaser or transferee, the contract date, the settlement date, and other details of that property. And they've made it quite clear they're going to use this information for data matching. No big surprise there. They continue to use data matching an awful lot. This information will also be included in pre-fill reports effective from the 1st of July 2017. They may also use it to cross-match against the foreign resident withholding regime that Mike would have spoken about. So as you can see, there's a lot of areas that the Tax Office are using data matching in, and they're ramping it up, including this quarterly report. So who knows what else they might be targeting next.
In legislation this month, Mike's going to take you through those bills that got pushed through Parliament just before it went into caretaker mode.
With the federal election coming up soon and the government currently in caretaker mode, we're not expecting a whole lot of progress on certain tax-related measures just at the moment. But it is really important to note that some tax bills did manage to get pushed through Parliament just before the election was announced and Parliament broke up for a while. In terms of the things that did get through at the last minute, the bills dealing with the new managed investment trust system, they have passed. Importantly, they also contain that little change that could impact on lots of self-managed super funds that hold interests in unit trusts. So the 20% threshold that looks at whether a trust could be treated as a public trading trust and therefore taxed as a company, when we're looking at that threshold, super funds from 1 July 2016 won't be taken into account in terms of identifying whether a trust is a public trading trust. So that was part of the managed investment trust changes. One of the other things that's gone through fairly quickly are the bills relating to the innovation announcements that were made by the government late last year. So tax incentives for investments in certain startup companies, those that are involved in innovative products and services. Also, the tax incentives for certain venture capital limited partnership arrangements as well. So those have been pushed through quite quickly. They're now law. They will start from 1 July 2016, leaving aside whatever happens in the election. The other bill that managed to get through, which would have, I guess, fairly wide application, is the rules that were announced a year or so ago about GST on services and intangible type assets being provided by non-residents into Australia to Australian consumers. Now, those rules don't start until 1 July 2017, but it's time to start planning for that. Again, if you're aware of clients or businesses that might be affected by those changes, that bill also contained the changes to the farm management deposit rules. So for primary producers, that could be quite relevant. Those changes by and large start 1 July 2016, so significant increase in some of the thresholds or the limits for farm management deposits, some relaxation on the rules in terms of getting money back out of farm management deposits as well. So again, quite important changes. I know some people have been really waiting for those changes to come through. It's good to know that they've actually been passed. They're law now. Those ones particularly will apply from 1 July 2016, again, regardless of what happens in the upcoming federal election.
And that's the tax roundup for this month. Remember, it's a new financial year coming up, and there's no better time to make sure that you and your practice are ready for it by joining Knowledge Shop. If you'd like to take a look at what we have available on the Knowledge Bank, through the help desk, through our quarterly training, then give Julie a call on 1800 800 232. We'll look forward to speaking to you soon.